and welcome to PubCA's 2022 Government Contracts Annual Review. We're thrilled to have more than 3,000 session representations for this program. My name is Alan Schwatkin. I'm the president of the PubCA Group and a partner of the law firm of Nichols Lew. I'll be your host, facilitator, and moderator for this year's annual review. And I hope we can convene in person next year. The PubCA Group consists of 3 newsletters: PubCA Law, PubCA Compliance, and PubCA Cyber. Many of you are already subscribers to one or more of these publications, and we very much appreciate your support. If you're not subscribing to all 3, I hope you'll consider doing so. Some of you are joining this annual review, but are not yet subscribers. Well, I hope you'll consider becoming a subscriber to at least one, if not all 3 of our newsletters. Information is at the website shown on the slide and is also available from any of the contacts that you know at the PubCA Group. This conference would not have been possible without the strong support of our sponsors, shown on the next 2 slides. I encourage you to look at the skills and the capabilities that these companies bring to the marketplace, and I hope you'll consider using them. In lieu of speaker gifts and in honor of our sponsors, PubCA is making a contribution to the Capital Area Food Bank. I hope you'll consider also making an individual or an organizational contribution. Since the entire program is being held virtually, all attendees will be in listen-only mode. Your video will remain disabled throughout the session. But we do welcome your questions. Use the Q&A box at the bottom of your screen. However, with so many attendees this session, it won't be possible to answer all of the questions in real time. We're capturing your questions and will endeavor to answer as many of them as we can at the conclusion of the annual review. Nevertheless, all presentation slides along with the audio will be available for download from the PubCA Group website, probably in a week or so of the conclusion of the annual review. We'll send you an email when we have that information available for you on how to download, how to access, and for how long the material will be available. You can also follow us on LinkedIn and bookmark our YouTube channel. We're also applying for continuing legal education in a number of jurisdictions. While we cannot guarantee approval, we expect the acceptance within a couple of weeks. Again, we'll notify all attendees when those approvals have been received. Finally, if you're interested in obtaining CLE credit, please look for our poll question during the presentation. The state boards require us to verify your participation in the event. The poll is a simple yes, no. We'll track the responses and if that you viewed the panel. If you don't wish to apply for CLE, you can ignore the question or simply answer for fun. Now, I'm thrilled to continue the 7th PubCA annual review with our Session 10 panel on mergers and acquisitions. Our distinguished panel members are Susan Gabay from Houlihan Lokey, Damian Speck from Morrison Forrester, and Catherine Hickey. I'm sorry, there's Catherine first, Catherine Hickey, and then last but certainly not least, Damian Speck from Morrison Forrester. Susan, over to you, please.
Thank you, Alan, and thanks for the opportunity to speak on this panel yet again. My name is Susan Gabay. I'm a managing director in Houlihan Lokey's Aerospace, Defense, and Government Technology and Services practice, and co-head our government technology practice. I have the pleasure and have had the pleasure for a few years of kicking off this panel with Damian and Catherine. And while the meat and potatoes of the nuts and bolts of how some of these transactions are getting put together will be covered by them, I get to introduce some of the higher level themes in terms of what we saw in 2021 from a volume perspective, from a valuation perspective. I'll spend a little bit of time on some notable transactions and trends, and a little bit on what we expect to see in 2022. So I'll start with a term that many of us are probably very tired of hearing over the last 2 years: unprecedented. And I think for those of us that spend time doing deals in the government contracting space, volumes, valuations, and some of the things that we're seeing in the marketplace are truly unprecedented. Volume last year was up almost 40%, roughly 140 transactions, up from about 100 in 2020. Really good balance between strategic buyer activity and private equity activity. The one thing I'll note that's sort of astonishing when I took a step back and looked at the volume metrics over the last 10 to 20 years, in the last decade, the volume that we saw in the second half of 2021 was higher than any full year over the last decade, except for 1 year, 2019. We had 98 transactions in 2019. We saw 92 transactions in the sector announced in the latter half of the year. Now, certainly a big part of what we saw in 2021 was driven by seller tax strategies coming off the last election and an expectation that we were likely to see an increase in capital gains rate. We saw a lot of companies initiate efforts to go to market in the first half of last year, which manifested itself with a high transaction volume in the second half of the year. And overall, it was an active year. If I asked Damien or Catherine how many vacation days they took last year, I'm sure they would probably laugh and joke that even if they took a day off, it was probably spent in a hotel room working on a deal somewhere. Next slide. Continuing on the same theme of unprecedented, we've seen median M&A multiples continue to rise. You can see on the chart, the median multiple for all transactions that were announced in the sector over the last year were up 14% from roughly 11 times EBITDA to 12.5 times EBITDA. We've continued to see a lot of interest and scarcity value associated with assets of scale. Generally speaking, in the space, that's anywhere from 100 million to $1 billion. There's just not as many of those platforms. And just to give some context on what we mean by premium for assets of scale, if you look at the over $100 million transactions, the median multiples went up from about 12 times EBITDA to almost 13.5 times EBITDA over the last year. And for the over $500 million assets, those multiples went up from about 13.3 times EBITDA to 15.1 times EBITDA. And so we've seen consistency in strong multiples being paid for assets of scale. At the same time, regardless of the size of the business, we are seeing that those companies that are positioned at the intersection of what we call technology and mission are generally trading at multiples that are substantially higher than anything that we've seen. So a sub-$100 million business, as an example, that has characteristics of technology, leading edge technology solutions, supporting mission applications in areas like space and electronic warfare, and cyber and autonomy. Those businesses are trading at generally up to mid-teens and higher multiples. On to the next slide. One of the, I think, interesting themes that we saw in the last year that we're going to continue to see in 2022 is a real focus around strategies that are technology driven. Virtually all of the strategics have a wish list of technology solutions or capabilities that they're trying to buy into. And there's a few examples here. We represented a company called Griffin Technologies and its sale to Mantech. Griffin was a digital engineering company that had some innovative capabilities in model-based systems engineering. Similarly, we sold a business called Gibbs & Cox to Leidos, which was a more traditional maritime engineering and ship design business that had developed some innovative capabilities around maritime autonomy. Booz has done a bunch of deals around digital transformation and cyber. Their purchase of TracePoint was interesting in that it was a two-step transaction where they made a minority investment in the business, followed by a complete buyout. We're seeing companies like Leidos and Jacobs make minority investments in businesses like Hawkeye 360. And so suffice to say, the strategics have been less focused on buying services businesses that are more of the same of what they do, and very much more focused on buying technology solutions that are going to accelerate growth. I might pause here, Damien, because given that there's been a lot of activity around some of these more tech-heavy stories, it might be worth you interjecting a bit around what you've seen in diligence around things like IP protection and some of the more specialized issues that come up in that context in a diligence process.
Yeah, sure, absolutely. I think that, thanks, Susan, the legal overlay here is that when you are doing diligence of a services business that has either some specialized intellectual property, or they're a supply business with some specialized intellectual property, you do need to, in the diligence process, get into where the funding for that came from, and not only that, but also how was it tracked? Essentially, could you prove it? If you had to prove that this technology or this intellectual property or this software was developed using private funds, could you do it? Do they have the systems in place to be able to do that? Do they have the legacy knowledge to be able to prove it? And then over time, have they protected it? Have they labeled it appropriately? Do they understand how to legend intellectual property in the government contract space? Do they have any requirements to deliver things like source code to their end customer? And there's deferred delivery and such things. And I think the other thing the other place this leads you is into all of the SBIR and OTA areas where 5 years ago, most of these buyers couldn't spell either one of those. And now I think they see them as valuable, but they're another piece of diligence to make sure that the holders of those, the targets, have been proceeding under them appropriately, and post-transaction that there's still going to be value in the vehicle and in the IP.
Yeah, I would agree with that, Damien. We've seen in a couple of these deals had a pretty significant amount of OTAs or CBIR phase 3 work, which we're running into a lot more. Next slide. So let's talk about private equity a little bit. You know, we've spent 20 plus years watching this industry consolidate. And when we started, and I started in this business in the late 90s, early 2000s, there were a handful of funds that had platforms in the space, companies like Veritas Capital as an example, and Carlyle Group. The amount of private equity activity that we've seen in the last 2 years is nothing short of astonishing. We had nearly 27 new platforms in 2021. As you can see in the slide here, that's 30% greater than the next best year over the past decade, which was 2019. We continue to see some of the brand names like Veritas be extraordinarily active in Arlington Capital. And I'll mention a couple interesting things that we've seen happen over the last year. You've got a couple platforms that have emerged as comparable in size to some of the larger public companies out there, with Amentum, which is backed by Lindsay Goldberg and American Securities, Peraton, backed by Veritas, in the last year acquired the Northrop IT Services business, and Perspecta. Both of those businesses have revenues approaching 10 billion. We've seen a number of new entrant funds maybe the fund names are new and the principles aren't necessarily new to the industry, but given the success that this industry has seen in terms of creating value, it's spawned lots of new funds that are starting to build platforms. A few of them I would name are Ocean Sound, Godspeed, CI Capital with its recent investment in Cadmus, and a Florida-based fund called Brightstar. And then I would also note, we've seen a couple interesting situations where we've had some really successful exits that funds have had. Carlyle, most recently with its exit of Novetta to Accenture, and Macquarie with its sale of Dovell to Guidehouse. Both of those funds almost nearly simultaneously entered new platforms around the same time that they were exiting. So the conventional wisdom of sell on the peak, buy on the valley. I think the indication that we're seeing from funds who are active in this space is, notwithstanding the valuation environment that we're seeing, they're still seeing this sector as an opportunity to create a lot of value, even though it is a frothy marketplace. Next slide. So I'll get into looking forward a little bit. We talked a lot about M&A volume, M&A valuations. It's worth taking a step back and looking at what the public companies are doing and saying and how they're performing, because that typically provides a backdrop for how they think about M&A. And the public company valuations, while they're still strong from a historical context, they've come down a little bit from their highs. I think they reached a peak of about 15 times EBITDA in 2019. They've come down a little bit in 2020 and 2021. While COVID didn't necessarily have as meaningful or really any meaningful impact on the sector initially, certainly relative to other sectors, over the last couple quarters, we've seen CEOs start to talk a lot more about supply chain challenges and award delays, particularly in the Intel community, and the impact that tight labor markets are having on wage inflation. And when you look at the public company growth rates that they're reporting, they kind of peaked in the mid-2019, early 2020 timeframe. You can see here that organic growth in the last quarter, the median organic growth rate for the large publicly traded companies like Mantech and SAIC and Leidos declined to 1% in the most recent quarter, down from about 8% in the third quarter of 2019. And so this could have implications both in the near term and the longer term on M&A valuations. As we've seen in the past, when some of the larger players started to face some growth challenges in the near term, it could drive them to pursue more M&A as a means to keep their growth rates up. And we certainly might start to see that over the next couple quarters if the growth pressures persist. The other side of the coin is if growth pressures persist and buyers scrutinize their own portfolios and recognize that driving growth is becoming more challenging, inevitably, that could color the way they think about valuing privately held businesses who may have similar dynamics going on within their businesses. So this is certainly something that we're keeping an eye on as we enter 2022. Next slide. I'm going to turn this over to Catherine, and Catherine will spend some time talking through some of the nuts and bolts of putting these transactions together.
Thank you very much, Susan. Obviously, it was an exciting year in 2021 and we all felt it. It's even more interesting to see the numbers verify our experience, I think, and looking forward to see some of that continue in 2022. We're going to talk a bit about how these transactions are most frequently put together and give a high-level overview of how parties should be approaching various structuring options based on the target and its assets and the nature of the business that you're looking to acquire. By way of introduction, my name is Catherine Hickey. I am the chair of the Business and Transactions Group at Polaro Mazza PLLC. We're a law firm based in Washington, D.C., and we work with a lot of government contractors of various sizes, a lot of small business contractors who have been involved in, again, a high volume of M&A activity last year. So we saw a lot of these deals, and we're going to talk, again, at a high level about what to consider when you're putting a structure in place. Some basic considerations for structuring are to think about what are the assets being acquired. Are we talking services and contract assets, or are there hard assets involved? Do we have real property? Do we have intellectual property? Do we have inventory? And what is the nature of those assets and how they're titled? What liabilities are being assumed by the buyer? What liabilities might exist that the buyer very expressly does not want to assume? What are the tax implications of the transaction? In both the commercial and the public contracting sector, tax is going to be one of the driving considerations. And then what third-party consents or notices are needed as a result of how the specific transaction is being structured. And that's going to change based on some of these options. Next slide. The three main buckets of structuring options are asset acquisitions, stock or equity acquisitions, and acquisition by merger. There are a lot of variations underneath each of these, but at a high level, what it comes down to is in an asset deal, the buyer purchases from the seller, the target company, some or all of the company's assets. It may assume some liabilities associated with that assets, but unless liabilities are expressly assumed, typically those are left with the seller company, with the exception of some very few statutory liabilities that follow the assets as a matter of law. In an asset deal, again, you don't have to purchase all of the seller's assets. That can be a more targeted acquisition, which sometimes is very attractive for a buyer. One example for public contractors is that liabilities associated with federal prime contracts can't be left behind if that's one of the bucket of assets being acquired. In an equity acquisition, the difference is the buyer is going to be purchasing the equity of the target company. So rather than buying the assets directly, the assets are going to continue to be held by the target, and then the target is the asset essentially that is acquired. The buyer would purchase equity to obtain ownership of the target directly from the existing owners of that company. This is a situation where unless certain assets, for example, are distributed out of the company or transferred out of the company prior to closing, and unless certain liabilities are satisfied or assumed or forgiven prior to closing, the buyer is going to be stepping into the shoes of the previous owners and taking on all of the assets and liabilities of the company. In a merger, this is a situation where under various state laws, the buyer and the seller combine entities such that one entity ceases to exist as a result of the merger and the other entity survives, and the surviving entity holds its own assets plus the assets and liabilities of both of the combined entities, the parties to the merger. So again, that follows the mold in terms of who takes on the liabilities of the acquired company, more similar to an equity acquisition than an asset acquisition. But the two companies essentially merge into one as a result of the transaction instead of continuing as two separate entities. Next slide. circling back to asset acquisitions, which from a conceptual point of view are often the easiest to wrap your head around. There's some pros and cons and things to consider specifically as it pertains to federal contracting assets. The benefits to a buyer is that the buyer doesn't have to assume all assets and liabilities. So if there are certain assets that exist in the target company that it has no interest in acquiring, it simply does not include those in the acquired assets. Those remain with the seller company. Same thing with particular liabilities, although you do have to make sure that you have structured the transaction to avoid any, by a matter of law, transition of liabilities associated with certain assets. But by and large, the buyer is going to be insulated from many of the interceding or preceding liabilities of the operation of the company as a going concern prior to closing, because it's not going to be stepping into the shoes as a successor to all of those pre-existing liabilities, again, with certain exceptions. So there's a lower risk to the buyer of potential liability after closing based on the pre-closing operation of the business. That's definitely an advantage. And it's one reason why buyers, outside of the federal contracting space often prefer asset structures. Typically, again, this is just that speaking in broad terms, an asset acquisition is also going to give the buyer usually a tax advantage because they'll get a step up in basis in the assets being acquired. And that's contrary to an equity acquisition, although there are some ways in an equity acquisition to achieve the same tax treatment. And it is also advantageous to the extent you have a seller entity that maintains multiple lines of business and the buyer really doesn't have an interest in all of those. It can, via an asset acquisition, kind of cherry pick those divisions or those lines of business that it wishes to assume and leave behind the rest. It also can be advantageous if the buyer has its own existing, back office support and it doesn't need to acquire those same internal systems from the seller. It can leave those behind as well and exclude them from the assets. From the seller's perspective, there is, a little bit less of a washing of your hands in an asset sale because you are left with, those assets that are not acquired in the business, as well as any continuing liabilities in the seller entity. So the owners need to figure out, well, how long do we maintain this company in existence? How are we going to wrap up or satisfy any outstanding liabilities? What continuing coverage do we need to be concerned about maintaining to deal with any lingering liabilities? Those are things for sellers to consider if they are selling via an asset deal. Some other negatives with the structure, it does tend to be from a drafting perspective, a little bit more complicated because you do need more specificity with respect to exactly what is being acquired, what is being left behind. Typically, that's not a material burden, but it is something that adds just a little bit more complexity and sometimes slightly more cost depending on the nature of the business and how granular that the transaction structure needs to be laid out in the definitive agreements. It can also increase the timeline to closing if there needs to be, specific valuing with respect to different classes of assets. And transfer of assets typically always means that any contracts that are being transferred to the buyer are going to require third-party, at a minimum, notices or a third-party consent to the ability to assign, because that will be an outright assignment of a contract, the majority of which are going to have standard anti-assignment language that says it cannot be assigned without the consent of the other party. With respect to federal contracting assets in particular, one reason that we see fewer asset deals in the public contracting space is because the transfer of federal prime contracts requires a novation agreement with the federal government in order to effect that transfer. The novation process is very lengthy. Historically, it has always run at, we typically would tell clients, like, assume at least 6 months for processing. Since COVID, we've seen that timeline extend out to up to 12 months, even in a couple cases longer. And this can create a lot of headaches for business parties who, obviously time is not something that you want to have a lot of in between inking a deal and finalizing the transfer of assets. Novation agreements typically need to be submitted on a post-closing basis. I have, in rare instances, seen some parties attempt to get them processed on a simply signed purchase agreement, not a closed transaction, but the FAR technically requires it to be on a post-closing basis. And you're often going to have contracting officers who won't evaluate them unless they have a closed deal. So when you're transferring contract assets that require novation, typically the parties are going to want to consider building in protections for the potential risk that the novation isn't approved. They have to provide contingencies for what they're going to do with respect to that particular contract work in between closing of the transfer of the rest of the assets and novation of the contract. Because if you're going to be transferring all of the assets and personnel associated with the performance of a particular contract that's remaining with the seller, usually you're going to need an interim subcontract at a minimum to enable the buyer to begin performance of the work while it's still technically held in the name of the seller. And so those are all, considerations that add, again, complexity. There's some more risk to the buyer because that novation is not going to be wrapped up until post-closing, although you can address that with holdbacks and unwind provisions and escrows and all of those things. But it definitely adds more of a headache. And as a result, a lot of times in this industry, we see more of a preference for equity acquisitions because it tends to avoid, a little preview of the next slide, tends to avoid novation issues. Last point to make with respect to asset deals is that if you're acquiring a target company that has a facility security clearance at the entity level, that's not a transferable asset. So if that is something that the buyer does not hold and that it needs to be able to continue performance of cleared contracts, that is not really going to be an option unless and until the buyer obtains its own clearance, which is a complicated process. And so again, transactions involving clearances also tend to lean more in favor of equity acquisitions. So acquisition of equity is a situation where instead of buying the assets, the buyer purchases from the owners of the target company the equity of the target company, so that following closing, you have the buyer is the parent company and the target company will be a subsidiary, and it may be wholly owned if the buyer acquires 100% of the target, or if there's some continuing ownership by the sellers, they're going to retain some equity. It may not be wholly owned, but typically the buyer is going to obtain at least a majority stake and become the controlling entity. In this situation, the post-closing ownership structure, if it's not going to be 100% owned by the buyer, is going to be one of the key points of negotiation in the transaction. The governing documents of the target company on a post-closing basis in that situation are going to be one of the definitive agreements that has a lot of the material business terms. So that's something to keep in mind. But the target continues to hold all of its assets and liabilities that existed prior to closing, just with a different owner at the top. So again, unless pre-closing, the target might distribute out certain of its assets to the owners. Say, for example, the company holds certain company vehicles that the buyer doesn't have an interest in obtaining and they've been personally used by the sellers. We often see those types of assets transferred out, or cash might be distributed out prior to closing. But most assets are going to transfer along with the target when the ownership changes. But the title on the assets remains the same, both pre and post closing, which simplifies things from, in particular, a government contracting perspective. Next slide. Again, I'll just run really quickly through some of these pros and cons for equity acquisitions. We've already touched on many of those. The buyer, because they're stepping into the shoes of the owners of the company, are going to assume all existing known and unknown liabilities in the company on a post-closing basis. So this is often addressed from a liability perspective via indemnification provisions and risk allocation in the definitive agreements. But at the end of the day, if the target company has liability for pre-closing operations, it's going to have liability to a third party, and the buyer is going to have to address that via either an insurance claim if it's covered by insurance, or an indemnification claim against the sellers. The default tax treatment for equity acquisitions is often less advantageous for a buyer as compared to an asset acquisition. In certain scenarios, you can have the option to make a tax filing to elect to have an equity acquisition taxed as an asset deal, which is something a buyer will often propose even at the LOI stage in connection with an offer for an equity acquisition. And then oftentimes you'll see the parties negotiate some sort of tax gross up payment to the seller, because usually that then results in like a net negative tax treatment for the seller as well. So that's often a point of negotiation. From a seller's perspective, once they sell the company, they're not left with any contingent lingering liabilities as a result of their ownership of the company, again, unless there's any claim that could attach to them personally. But they do usually have liability that's left under the indemnification provisions of the purchase agreement to the buyer, unless it's a walk away deal, which you sometimes see, especially in higher transaction values. A lot of times equity acquisitions are going to be difficult to manage if the target company has a lot of stockholders, because each individual holder typically has to individually agree to the sale and have the opportunity potentially to negotiate. As a practical matter, oftentimes they'll appoint a particular controlling stockholder to act on their behalf. But sometimes you'll see this create a lot of issues, which in certain circumstances can lead to a preference for a merger structure when you have a complicated ownership. So we can move on to the next slide.
Well, and Catherine, before we do that, I do want to just jump in on one point, which is, and it's implicit in what you've already covered, but it seems to me that the diligence that one has to go through for the compliance of the company, its policies, its procedures, its history is much more intense in an equity acquisition than it is in an asset purchase. Because in the asset purchase, I can pick and choose and I can leave liabilities behind. So I'm only diligencing the items I'm picking up, and I'm less interested in historical issues that can't impact the current value of the assets. I assume you agree with that.
Yeah, that's 100% accurate. For a buyer in an equity deal, you're taking everything that has historically been performed, whether properly or improperly, by the target company. And so you're correct that the diligence effort does need to be higher in an equity deal to make sure that you've fully vetted the potential liabilities that you could be acquiring there. And that's going to be a significant point of focus for any buyer in an equity acquisition, definitely more so than an asset deal. Some considerations with respect to government contracting assets in particular with equity purchases. Again, one reason we see these favored in the public contracting space is because you are not required to novate the prime contract held by the target company if they are remaining with the target company. So in an equity deal, it's the ownership at the upper level that changes, but the title to the contract itself remains with the same entity. As a result, from the government's perspective, there is no transfer or assignment of that contract, so you don't have to get a novation agreement executed with the federal government. What you do often need to do, and this is particularly true for small business contracts, is if there's a change in ownership of the company, which there will be as a result of the sale of equity, you typically need to notify the government of the change in control, the change in ownership. And if you have a small business set-aside contract, usually that'll trigger a recertification requirement where you need to, in connection with the notification to the government of the change in ownership, you would say, and whether or not you can recertify for the same small business status that the contract was awarded with to the target company at the time of award. These notification requirements or recertification requirements typically are not required prior to closing. Usually have 30 days post-closing to send a letter to the agency satisfying these notification requirements and recertifying or notifying them that you can no longer certify. there might be a little bit of follow-up, but it's typically more of an administrative process, much simpler than a novation. You do need to consider if the buyer is not going to be able to have the target company recertify with as small, or if it had other small business set aside contracts, like if you're a service disabled veteran-owned small business contract or woman-owned small business contract, and that will no longer be available for the target company post-closing, you need to consider, typically that doesn't mean that the company cannot continue to perform the work on those vehicles. The customer won't be able to take set-aside credit with respect to that on a post-closing basis. It may impact ability to bid for future work if it's the IDIQ contract, for example, and it may also impact the exercise of options in the future. So those are all things a buyer is going to want to consider when it looks at the value of the assets it's acquiring and how much that it can maximize to the extent some of that value is tied to set-aside status. So something to keep in mind. And then just touching back on the facility security clearance point, because this is something we get a lot of questions on in an equity acquisition, because the target company is going to remain in place, it can typically continue to hold its clearance and perform cleared work. To the extent the buyer does not hold the same level of clearance that's required to support that work, there are going to be some hoops you have to jump through to make sure that there are no foreign ownership control issues, and to make sure that the buyer is going to be excluded from controlling that cleared work. And all of that is stuff that you would work through with Dcsa, and we have some future slides on that. It's something to consider. Next slide. With respect to mergers, I'm just going to fly through this really quickly because I want to make sure we have time to get to some of our content at the end. Again, this is where the buyer and a target will combine via merger filing, and the acquiring entity will become the owner of both its own pre-closing assets and liabilities, as well as the assets and liabilities of the merged entity on a post-closing basis. This has a similar liability exposure issue for the buyer, depending on how the merger is structured, but usually the acquiring entity is going to succeed all of the liabilities of the seller. It also has the negative impact from a government contracting perspective in most merger structures, although not all, of requiring a novation of prime contracts to the extent the target company is not the surviving entity in the merger. So there are some ways that mergers can be structured where the target company is the surviving entity. In that case, there would be no novation required because the target remains in place. And that would be similarly true for any security clearances held in that company. But if the target company is merging out of existence, that will constitute, for purposes of federal prime contracts, typically an assignment of those contracts and would require a novation. Next slide. Something to keep in mind, we've already talked a lot about novation, so I'll just very quickly run through it. These are required under FAR Part 42 with respect to the transfer of any government contracts, which can only be transferred with the government's consent. The government has to find that it's in its best interest to approve the transfer of the contract. And so there is a possibility in some cases that the government could decline to approve a novation, which again creates risk to the parties and in particular to the buyer, all of which we would typically see worked out in the terms of an asset purchase agreement where a novation is going to be required, or a merger agreement where a novation is going to be required. They are typically only processed following closing. And from a liability perspective, this is one of those exceptions in an asset deal where usually the buyer is only acquiring the liabilities that it wants to pick up, and those would only be on a going forward basis. For federal prime contracts under the FAR, when you novate a contract, the government essentially requires the seller to guarantee the post-closing performance of the contract and the buyer to guarantee the pre-closing performance of the contract. So that's a liability issue to keep in mind that the parties may want to work out under the indemnification provisions of the purchase agreement. And again, it's a very lengthy process. So parties are typically very motivated to avoid novations wherever possible. We can move forward to the next slide And I think this is where I'm going to turn it over to Damien, who's going to talk a little bit more about clearance issues and then have some case law updates for us to close us out.
Thank you, Catherine. And I'll add on to your discussion, making one point, which is don't assume that the government contracting officer that you're dealing with has ever done a novation before or has had to deal with the nuances of the differences between a stock transaction, an asset transaction, a merger, et cetera. That's not their day-to-day. And so I think we advise clients to be very regimented in their messaging, to make sure they are crystal clear as to what kind of transaction occurred, and to make sure that whether that messaging is going to DCMA, it's going to your contracting officer, it's going to DCSA, it's in a press release, that all of your messaging is consistent so that you don't end up confusing the government folks who don't live in this asset merger, stock transaction kind of world. So Dcsa considerations, this has been touched on a couple times in Catherine's discussion, that the clearance does not transfer in an asset sale or merger. So you have to be in a circumstance where either the buyer has their own clearance and you are taking these assets and the cleared work that is with them into your facility clearance, or you're probably going to be looking at getting a new clearance, which if you think novation takes a long time, getting a new clearance can take even longer. And then you're also, the other option is to look at a stock transaction. And that's really where the second bullet goes here, is a non-cleared buyer, whether it is a private equity firm or an operating company that just doesn't have a facility clearance, can hold a cleared facility as a wholly owned subsidiary. As long as you go through, I think what was referred to before as hoops, that's probably generous. No foci concerns. That doesn't mean that you don't have any foreign ownership, control, or influence. It just means that it is either mitigated or is it a small enough amount that it's considered to not have any impact on the business. And the way that that gets dealt with is in the submission of a change of condition package after closing. And socializing it pre-closing, I mean, we generally say you don't want to surprise DCSA. So if there are notices, in general, DCSA likes to have a phone call from the facility security officer of the target. So if that individual who is read in, we like them to pick up the phone, call over DCSA, and to disclose the nature of the transaction, and try to iron out any issues that might pop up. We'll say 9.5 times out of 10, this is a smooth post-closing process. The KMPs of the subsidiary remain in place. It's important that at least some of them do, and that's for the continuity from DCSA's perspective. Even if they only remain in place for a period of time, it's important to keep them in place. Obviously, the cleared personnel will remain in control of cleared work. And then what you're going to do is you're going to put a shield between the cleared subsidiary and the parent through what are called exclusionary resolutions. Basically, just say we're not going to share information between the two entities. So let's dive into the case law for our last section here. So there are a few cases here. One SBA case, which we reference here, and otherwise GAO cases. And what we're finding here in the last year was GAO being faced, I think because of the number of transactions that were happening, as Susan referenced, with a number of situations where there were pending proposals. There were outstanding proposals at the time of a transaction, and then there was a later award. And all of these cases go to that point, and they look at it from different perspectives. The first is in Odyssey Systems Consulting Group, and you can see there's a B number there because it was a GAO case, but there is also an SBA Office of Hearings and Appeals case on this same point. And fundamentally, the question in Odyssey was, if a company has bid under a small business IDIQ contract, has bid for a set-aside task order, where it was eligible for that order at the time that it submitted its bid, but where it had to recertify its size status while that bid was pending. So it is no longer small and the bid is still out there. Does it remain eligible for award? And there's even more pressure on this particular area, given the passage just a couple of years ago of the SBA's 180-day rule for proposals, where if a company has to recertify a proposal and the proposal has been pending for fewer than 180 days, then it is unawardable. Interestingly enough, the answer from GAO's perspective, from SBA's perspective as well, is that a company that recertifies a set-aside task order during the pendency of that proposal remains eligible, despite the 180-day rule, despite no longer objectively being small, remains eligible for award of that contract. And so I think there is some level of certainty there that as long as you were eligible when the proposal went in, that you then remain eligible. So that was an unanswered question. And I think it is now the answer, at least for set-aside task orders on set-aside IDIQs. You would have a very different answer, I think, for standalone contracts. Next slide. Next case is Morgan Business Consulting. This is an interesting case where there was a press release related to a transaction. Interestingly enough, it didn't involve Morgan. It involved Morgan's subcontractor. And the agency became aware of a change of control of the subcontractor, and it assigned Morgan a number of weaknesses related to the sale of its key subcontractor. And so after award was made to a different party and Morgan became aware of these weaknesses, they went to the GAO and they said, well, this doesn't make any sense. There was this other letter, there was this press release that all explained that this would have no impact on the subcontractor's ability to perform. And essentially, the GAO laid out the test that it has laid out in the past, which is, number one, if an agency becomes aware of a transaction, then it must consider the impact of that transaction on a given award. But what this case then teases out of that is, if the agency then makes a conclusion based on inadequate evidence, they judge it based on this press release and whatever else they could find, the GAO will defer to that determination as long as it's reasonable. And so here, Morgan's protest was denied, even though it had counter arguments as to why it shouldn't have gotten weaknesses. The information that the agency had at the time led it to the conclusion that this could be a problem. And so I think that the lesson we take here is make sure your press releases actually accurately characterize what's going on, that being a subcontractor does not protect you from some of these risks, and that there may be a need to have an affirmative conversation with the government about transactions that occur, even if they're stock transactions. Next slide. So the next slides are on this Vertex case. It's another GAO case, just very recently published. And this was an affirmative protest by Vertex of an award to DynCorp, which had just been acquired by Amentum. And in this circumstance, unlike in Morgan, the agency was unaware of the acquisition upon receipt of the proposals, but then it found out, not through a press release, it found out about the transaction through a novation request, because some of the assets of DynCorp were going to be moved into other parts of Amentum, including the underlying IDIQ contract that was at issue here. And really where the agency fell down here, because this protest was sustained, the agency fell down because it did not analyze those materials. The GAO found that the agency was aware, but it drew essentially no conclusion, or a poorly documented conclusion, as to what risk that transaction might have on the actual award of the contract and the ability to perform. And despite the Amentum's post-award assurances, that was insufficient because the agency had not considered those facts at the time. So again, flashing back to Morgan, I think the question here is Is the agency aware? Well, first off, the agency reads the newspaper, so they see press releases. So make sure that stuff is accurate and it's fulsome and it gives them the assurances they need. And again, consider whether or not to raise these issues for pending proposals in order to avoid a circumstance like DynCorp found itself in there. We can go to the next slide. This slide has a bit more detail on that particular case, but it also brings up in the last bullet the piece I want to draw out, which is that there was another case involving exactly the same transaction, and that's the PAE case. And in that case, the protest was denied. And so if the same transaction caused two different effects, maybe we can learn something from the difference in those two cases. And in the PAE case, the difference was that the agency had actually gathered information and had made a documented determination that the acquisition did not change the nature of performance, did not change the resources available to perform. And so, because of the difference in what the agencies had done and the information that was available to them, the same transaction occurring during the pendency of two different proposals came to different outcomes. And so again, I think the key takeaways from the way that the GAO's case law has developed as regards pending proposals is that the cases will turn on whether the agency is aware. They're not going to turn necessarily on the structure, whether it's an asset acquisition or a stock acquisition. And the agencies read press releases, they become aware. And so if there are major proposals that are pending, whether you're a prime or a sub, it may make sense to put the good facts in front of the agency and assure them that there will not be any change to performance as a result of a transaction. If the agency then adopts that rationale, the GAO will defer to a reasonable and documented conclusion. So I think some really important cases, and the fact that 3 of them came out in 1 year tells you something about what's going on in our transactional space. Next slide. So I think we had some backup materials that we've provided here to show the structures and other items. So folks want to review those. They may be helpful in visualizing what Susan and Catherine were talking about in terms of the organization of proposals. And with that, I will thank you all for tuning in. I'll thank my fellow presenters and turn the presentation back to Alan. Thank you all.
Damien, thank you. And thanks to you and Susan and to Catherine. There's a reason why you guys are repeat presenters, and obviously seasoned veterans and know this area very, very well. People learned a lot from this. Let me again thank our panel members for their participation. Let me again thank our event sponsors for their support. Couldn't have done this program without them on this slide as well as on this one. I hope you consider using any one of these outstanding organizations for your government contracts needs. That concludes our sessions for today. Thanks, and I look forward to seeing all of you tomorrow.